Hey everybody, I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Well, since the market was closed yesterday for President's Day, we're probably going to officially call this one 2 Minute Tuesday. Even the bond market needed a long weekend. Now, each week I break down what's happening in mortgage rates, housing, and the economy kind of in layers. So first, I'm going to give you the quick, hey Doug, just tell me what time it is version. Then we're going to go on and we're going to talk a little bit more about how the clock works. And then finally, for those of you who really like to understand the mechanics behind housing and mortgage rates, as well as what's driving them, we're going to build the clock together. So let's go ahead and start with what time it is. As of today, national average mortgage rates per Mortgage News Daily, they're roughly 6.04% for the 30-year fixed rate. The 15-year is at about 5.61. And then the 30-year FHA, it's about 5.62, and 30-year VA is right at 5.64. And jumbo loans are sitting right at 6.27. Now remember everybody, that's the national average. That number is built on credit scores across the country, loan to value ratios, meaning the equity you have or maybe the down payment on a purchase, your debt to income ratio, the loan size, the property type, your lender, and whether or not there's discount points baked into that loan program. Now, in this environment, there's a lot of lenders that are quoting rates that include 1 to 1.5% in upfront discount fees. And personally, I do not love you paying heavy discount points right now. Most real estate economists, they believe that there's a really strong likelihood of refinance opportunities in the next 12 to 18 months if inflation continues cooling. Now, if you pay several $1,000s up front to buy that rate down and refinance in a year, you're never going to recoup those costs. So right now, for most clients, we're focusing on a strong rate, minimal or no rate buy down unless it's absolutely necessary for approval or affordability, and keeping as much of your hard-earned cash in your pocket as possible and maintaining flexibility. Now, for all my homeowners out there that bought in the last few years and you're dying for some rate relief, if your current rate's approximately 6.75 or higher on a conventional loan, or 6.5 on FHA, VA, or USDA, or maybe 7% or higher on a jumbo loan, it's probably worth at least reviewing your refinance options as long as you're working with somebody who has a really strong understanding of the market, which unfortunately isn't that common. Now, that doesn't mean that we're automatically going to jump into a refinance right now, but if you're about 5/8 to 0.75% above the national average right now, that's typically where the math starts to make sense. Now, here's your quick economic snapshot. The job report showed 130,000 jobs added. Unemployment fell to 4.3, and inflation has actually eased to 2.4% year over year. And that's an 8-month low. Now, core inflation came in at 2.5%, and existing home sales fell 8.4% month over month. Mortgage bonds, they're pushing resistance, and momentum right now, it slightly favors lower rates. And that's what time it is. If you're finding this information helpful, please like and subscribe. And if you know anybody who's considering purchasing or refinancing, I sure hope I can count on you to send them my way so they can at least get a second opinion. Now, if you just wanted to know what time it is, your work here is done. Now, for my friends that crave just a little bit more detail, let's dig deeper because the headline doesn't always tell the whole story. And starting with the jobs report, yeah, we added 130,000 jobs, but ADP showed only 22,000 of them came from private payroll. Now, their 4-week average implies around 41,000 per month. And job openings, they dropped pretty sharply. And the 2025 job growth, it was revised by 403,000 jobs. So here's the important part. In raw January data, payrolls actually fell by 2.65 million jobs. Seasonal adjustments turned that into a positive 130,000. Now, January always sees heavy seasonal layoffs from holiday hiring, so the adjustment's pretty darn large. Now, the structure underneath the headline suggests the labor market's cooling, and when labor cools, bond markets tend to respond favorably. For inflation, the Consumer Price Index, or CPI, it came in at 2.4% year over year. Core inflation, which actually strips out food and energy, it was at 2.5%. And shelter costs, which are the costs of housing services that are consumed by households, rather than the investment cost of purchasing a home, it actually makes up about 35% of headline CPI and 44% of core inflation. Now, even small changes in shelter heavily impact overall inflation. January's shelter reading was fairly modest. Airline fares spiked, but the overall trend is easing. And this Friday, we're going to get PCE, which is the Fed's preferred inflation gauge because it measures the prices that a household pays for goods and services. But that's going to reflect December data, and we've already seen January CPI improve. The broader trend is cooling inflation. Now, from a housing standpoint, existing home sales, they did drop 8.4% month over month. Now, inventory on homes that are currently listed for sale, it's at about a 3.7 month supply, meaning that if no new homes were listed, we'd have enough houses to last 3.7 months. Now, a balanced market, it's around 6 months, and we're not there. So this is definitely slower activity, not excess supply. Now, prices aren't collapsing. And affordability, it's actually improved compared to 2022 levels, and that really matters. All right, now for my friends that like to know how to build the clock, because this is where strategy actually matters. Affordability is the number one thing for most folks today, so discount points are being thrown around a lot. And let's talk about this a little bit. A discount point, it's basically prepaid interest. 1 point equals 1% of your loan amount. So on a $400,000 loan, 1 point equals $4,000. You pay that up front to lower your interest rate. Now, there are temporary and permanent buy downs. And the deal here is, though, that lower rate, it equals higher costs up front to either you or the seller. Now, the key question is always, what's the break-even point? All right, here's an example. Let's say that 6.125% doesn't have any discount points, and 5.875 costs around $6,000. Well, that buy down is going to save you about $120 a month. But if you take $6,000 and divide it by that 120, it equals about 50 months. That's over 4 years just to break even. So now you got to ask yourself, do you believe that you're not going to refinance in the next 4 years? If rates drop in 12 to 18 months, which a lot of economists believe is not only possible, it's likely, you're never going to recover that $6,000. And that's why in this environment, I prefer flexibility over perfection. Avoid overpaying upfront costs. Refinance strategically whenever the opportunity presents itself. Cash gives you options, and I like keeping as much of that cash in your pocket as possible so you've got as many options as possible. All right, now let's go ahead and talk about why we think rates are going to be improving over the next year or so. So mortgage rates follow mortgage-backed securities. Mortgage-backed securities follow the 10-year Treasury. The 10-year moves based on expectations around inflation, labor, and economic growth. Well, right now, inflation's easing, labor market's softening beneath the surface, and continuing jobless claims, they remain elevated. Investors are moving into bonds, and when bond prices rise, mortgage rates improve. Now, technically speaking, mortgage bonds have been stuck in kind of a range for some time now, but they are testing that resistance. And the 10-year Treasury, it's actually hovering around 4.05%. If it breaks towards that 4% level, that likely puts additional downward pressure on interest rates. Now, the more we see inflation ease while also experiencing labor force weakness, the more we should see rates improve. Not overnight, but over time. Now, that's the mechanism. That's how the clock's built. So, what does this mean for you? Well, waiting for rates to fall and prices to fall at the same time, that rarely, if ever, works out for anybody, and it ends up costing people a lot of money and a lot of equity that they could have had. Now, when rates fall meaningfully, demand returns. And we've got a ton of pent-up demand sitting right on the sidelines, waiting for a magic rate to appear. That makes homes increase in value, meaning that you're going to pay more for the same house. Inventory is still tight, and there's just not an easy button that somebody can press to change that, at least not in a reasonable amount of time. That puts upward pressure back on prices. The takeaway here is you can refinance a rate. You can't refinance a purchase price. Smart strategy beats trying to perfectly time the market almost every time. Hey, if you showed up for 1 Minute Monday, you just got the bonus plan, baby, with 2 Minute Tuesday. And here's the summary. Inflation's easing. The labor market's cooling beneath the headlines. Housing's tight but slower. Bonds are pressing resistance. And rates, well, they've improved. And we're watching key technical levels really closely. So, hey, if your rate is above that refinance threshold, let's review your numbers. If you're buying, let's structure it correctly the first time. And as always, we proudly support our military, law enforcement, and firefighters through the Home Foundation. If you're a local hero considering buying or refinancing, make sure you reach out today. We're never going to bug you to do something before you're ready. We just want to make sure that we're there for you the way you need us whenever you are. And we've also got a local network of professionals that are eager to serve you because you either have or are serving our country or our community. Now, if you aren't, that's okay too. You're going to benefit from the system that we work hard building every day to honor them. Hey, everybody, thanks for watching. I'm Doug Shoemaker with the Shoemaker Loan Team, and I'll see you next week.